Hi everyone, it is Monday the 9th of October, and that means it's time to take a look at what moved the markets last week. Since we're at the very beginning of earnings season, I thought that I might start with one of my portfolio companies that reported earnings last Friday. You'll also see that anyone that copies me will be receiving these payments from the bond ETFs that we currently hold. The company in question that reported earnings was JDW. This is a London listed company called JD Wetherspoons. For those that don't know, JD Wetherspoon is a 4-decade-old franchise. It's a pub chain in the UK. They're well known for selling cheap and cheerful drinks and food. And the man that owns the business is well known for having strong opinions about things and being quite quirky. I don't agree with his politics, as one example, but he's an incredible operator of this business. One of the reasons that I like JD Wetherspoons quite a lot as an investor is that the business is very well run, and that includes through the pandemic. So they suffered like many other businesses, but nowhere near the same degree, just because of how well they controlled their costs and how well they marketed themselves to their customers. I'm not going to go through the whole annual report, but I encourage you to take a look. It is actually quite funny, in parts just because the people that operate JD Wetherspoon are very down-to-earth, quirky, intelligent, and witty people. However, I did want to pull up this page. This is a table summarizing the business since it opened in 1984. And you can see that when the pandemic started, the company swung from what had previously been a strong profit. The company had actually been profitable every year that it had been run up until the pandemic, to a loss. Of course, this affected their free cash flow. And since the pandemic, they've been trying to recover from the situation that they were forced into. On Friday, they did report their yearly numbers, so you can see the final line here. They reported record revenue, which is kind of to be expected because of inflation. Inflation has driven up the cost of things, which means that part of the record in revenue is because those costs have been passed along to the customer. But even better than that, we can see that the company has swung back to a profit and now has free cash flow to the tune of £271 million. The stock did drop on the day that earnings were reported. The man that owns the business, he is a straight shooter. He tells it how it is, and they've seen a bit of a slowdown through their first financial quarter of this year. I suspect because a large part of the UK has been elsewhere. They've been on holiday in other countries throughout the world. But he's also said that it's going to be difficult to continue to grow revenue as rapidly as they have through the coming year, because they do anticipate rising costs, in part because of inflation. So if we take a quick look at the numbers, you can pause the video and read them on screen if you would like. You can see that revenue has been growing, took an enormous dip through the pandemic, and has returned to growth once again, and is expected to continue to grow, as was the trend pre-pandemic. As I mentioned previously, the lockdowns, the coronavirus brought with it, forced the company to its first loss in its entire operating history. And now the company expects to continue making profit, growing profit for the foreseeable future. Now, previously, the company did also issue a dividend, which it stopped doing when it swung to its first loss. I expect that this will come back somewhere within the next year or so, although that's not the reason that I hold the stock. And something that I also find quite compelling is the business picked up a lot of extra debt through lockdowns, as many companies in the retail, leisure, and hospitality industry had to in order to survive. But now they are paying down that debt aggressively. You can see that they've paid down nearly 300 million in the past year. So this is a company whose share price is fallen off a cliff. It peaked nearly 3 times where it is today. It collapsed under the pressure of coronavirus lockdowns. It has battled to recover because sentiment around the UK economy has been quite negative, although it has improved enormously through the past few months. And because they had taken on a whole bunch of extra debt to survive the pandemic. Now they are climbing out of that debt hole. They're returning to revenue levels that they had previously seen, and profitability should reach levels that the company had pre-pandemic over the next 1.5 to 2 years or so. Unfortunately, I'm having some kind of a technical challenge buying more of this stock on eToro. I've had the same challenge for a while, so I'm not able to add it to my portfolio right now. If I could, I would. I've been trying for a few days now. But it is a company that I've invested more into outside of eToro, because to me, it seems like a no-brainer. For the patient investor that's willing to wait 1 to 2 years, I think that you could get quite a good return out of this company. All right, moving on to our standard scheduling. So through the early part of this month, the NASDAQ100 and the SP500 have tried to recover from the awful September that we experienced. You can see that the NASDAQ100 was up 1.5% through the first week of October. However, that picture has slightly changed now. The reason for this being there was a lot of macro data that became available to us, but the most important of it was the non-farms payroll number that we received on Friday. Now, non-farm payrolls, as I mentioned, I think last week, it measures the change in the number of people employed during the previous month, excluding the farming industry. So it's an indicator of job creation, and this number came in nearly double what was expected. Investors and economists will see this as a data point that says the labor market continues to be very hot, and that it is likely that the Fed will continue to raise interest rates in order to offset this to some degree. In part, that is why we saw many stocks take a tumble on Friday and today. And this is despite the fact that on Friday, the unemployment number out of the US crept up slightly and exceeded expectations. Now, not only did stocks dive on the back of this hot labor market news, but the yield on bonds in the US government bonds rose. So on screen we have the yield for the US 10-year bond, and you can see that last week, this is a weekly chart by the way, you can see last week it reached a level not seen since August 2007. So yields on bonds are incredibly high at the moment, which means that the prices of bonds are incredibly low, and I will continue to buy bonds for this very reason. The biggest news of the past few days, the weekend in particular, is the conflict in Israel. Hundreds of people losing lives and their homes. It's a terrible tragedy. And because this conflict is in the Middle East, it will affect the price of oil. So we can see that through the last 2 weeks or so, the price of oil seemed to hit a peak and that oil was falling, but it has rebounded now with the expectation that there might be some interruption to the supply of oil out of the Middle East. The reason that this might affect the prices of stocks, and I think that it is a large part of the reason that stocks have fallen today, is that a high price of oil means a higher price of energy, and if that is sustained for a long time, that will drive inflation higher because many things depend on oil. Higher cost of oil means that everything else in that supply chain needs to be adjusted upwards too. Something else that I was reading through the weekend, I mentioned this a few videos back, is that the US consumer is starting to be tapped out in terms of savings. And in fact, they are starting to be tapped out in terms of credit too. We're also seeing an increase in defaults on loans in the US, although the level of defaults isn't higher than what we've seen pre-pandemic, but it's still another data point to bear in mind. So through the pandemic, consumers were able to save a lot of money. They weren't able to spend money on all the things that they wanted to, but also there was helicopter money and other forms of stimulus, which increased the amount of money that people were holding in the bank. Once lockdowns ended, this meant that there was a lot of money sloshing around the system to be spent, but savings are only going to last for so long. And now it seems as though consumers have torn through a lot, the bulk of those savings, and now are turning to credit cards. But buying things on credit at the moment is becoming very painful because the interest rate that you are paying on a credit card has been driven significantly higher because it has some foundation in the interest rates that the central banks set. And as you can imagine, if you have very little savings and you've been buying things on credit, and now the rate that you've been charged on those credit cards is increasing, you're going to slow down your spending significantly or go bankrupt in the process. The one bright spark in all of this is that the labor market is still strong. So people are still being paid. There are lots of people that are employed. So they should be able to service some, hopefully most of this debt. But if the unemployment rate suddenly ticks up, then there's going to be a big problem. All right, so what's going on this week? Well, there isn't a lot of news that is hitting the wire, but it is very important news. So on Wednesday, we're getting the PPI number out of the US. This is the leading inflation number, the producer inflation number, and we also will get the CPI and core CPI numbers out of the US the following day. These are the lagging indicators that tell us what has already happened. On top of this, we will also get the jobless claims number out of the US, another data point around the labor market. And as a UK citizen, I'll be quite interested in the GDP number that we receive on Thursday too. The final thing to take note of is that at the end of this week, on Friday the 13th, we will see the first of the large US banks reporting earnings. From then on out, it is likely that earnings will be the thing that steers the market. Everyone is watching very closely to see how earnings are doing. Earnings expectations have been revised downwards through much of this year, but they've still been a lot stronger than many people have expected. If there is an earnings recession on top of everything else that we're seeing in the world at the moment, then I think that markets could be quite heavily affected through this earnings season. What's my plan to weather the storm if we do see a storm through the rest of this year? Well, I'll spend some time explaining why I like buying bonds via the ETFs at the moment. Not only do we receive a dividend for the money that we put into them right now, if and when rates are cut, that means that the prices of the bonds in those ETFs will rise along with them and we can sell out of them. I will also keep some cash on hand. But the thing that I think many investors are misunderstanding at the moment is, yes, there are some stocks that are very expensive out there, especially given the economic conditions. But there are also a ton of companies that are incredibly well priced. The largest companies within the US have pulled up the indices through this year, but there are a huge number of participants in those indices that haven't seen meaningful appreciation through this year. Over the long term, the global economy grows. The economy is made up of people and companies. So whilst there might be hiccups on the road to growth, like we're experiencing at the moment, in the long term, growth is something that we will see. All right, that's it for this week. I hope you have a good one. Speak to you soon. Goodbye.